a lot of uncertainty is still looming for the markets. We have, what's playing out in West Asia with Iran and Israel. I mean, pretty much it looks like things could escalate over there. For now, they are at a standstill, but both sides have indicated that, Israel has said that it may retaliate, and Iran has said that it won't hold back either. Also, we are hearing a bit of a pivot from Mr. Powell as well. His recent comments are increasingly, sounding more hawkish. We were expecting about 2 to 3 rate cuts. Now the idea is, maybe 1 or 2 or none at all this year, sir. What's your sense of things and how are we positioned currently?
I think it's very difficult for him to really cut rates. I think that's something that we've been saying since January because bond yields are actually going up. A lot of people think that the Fed controls the bond market, but if you really look at the history, it's the bond market that controls the Fed. In other words, they simply follow the market. If bond yields are rising, 3 to 6 months later, you'll find them raising rates. And if bond yields are falling, 3 to 6 months later, you find them cutting rates. What they can do is use language as commentary, which is sort of what they were doing in between by talking about, cutting rates. They were probably hoping that bond yields would fall. They did for a while between October and January, but after that they started to go up. Now the market continued to listen to the idea that rates will come down, and so they continued to rally throughout this period. But we have been seeing it as an ending structure, at least as far as the Nifty is concerned, because in Nifty, while we've made higher highs, the progress has been very, very limited. I think certain stocks may have done very well, but the index itself has not done that well. And the weekly momentum indicators on the Nifty also remain in sell mode. So in general, I think the trend is, in line with what world markets are doing, which is they are paying attention to the idea of higher rates from here. So they remain the same or they could move higher. My sense is they eventually move higher, not even lower. So that risk has to get priced into markets, which has not happened. But the momentum indicators do indicate it will happen because they are all in sell on weekly levels. If you look at, whether it's the S&P, Nasdaq or the Nifty 500, the weekly momentum indicators are on the sell side, and that I think is what we are seeing playing out.
All right, considering that technical indicators are on the sell side, and you just mentioned that markets have not yet priced in a higher for longer interest rate regime in the US. Considering, what would be the worst case scenario if the things do move the other way? We remain in an elevated interest rate environment, as well as the situations, the tensions in the in the Middle East, they worsen. What would be the worst case scenario? Where can and how much by Nifty will fall?
So right now, I'll put the first major support at closer to around 21,122. And that will be a level where we will try and consider, is this the worst case or is it going to be worse than that? Once we break that, then we'll open up scenarios that are much worse. But in my mind, I would be prepared for the possibility, but it is an important support. We have seen similar support hold even in October, so we'll pay attention to it. So 21,100 odd for the for the Nifty is what should really be the downside we should be prepared for as of now.
All right. That's about 1100 points from where we are currently. So a big crash could come our way if things do decide, things move the other way. But so interesting move on oil prices. They were edging higher. We were above $90 a barrel when we left off on Tuesday, but 3% decline in the last 2 sessions. We are currently above around that $87 a barrel mark on Brent crude. What do you think led to this 3% pullback in crude prices? Is the market, the lack of cues coming in from the Middle East that the tension is not escalating over there, is that being perceived as good news by the market?
It could be because probably for example, you haven't really seen an oil spike even when these recent events happened, right? You didn't see prices go beyond the high that we made on the 5th of April, which was closer to around $87.63. We've remained below that throughout this period, despite all the negative news. So surely there was already pressure for some reason. and geopolitics is probably not the main driver as of this moment. Uh, but we are back to support. If I simply look at the trend line from the bottom that we made in February, we are at that support, which is closer to around $82.5. So now, if we hold 82.5, I would sense that the uptrend actually resumes in oil. So it may just have been a temporary technical correction. It's true that maybe no negative news has led it to pull back to the bottom end of the range, but it has not really broken the overall upward trend that it has been in for the last 2-3 months. And so that is why I would still think that oil prices are headed higher.
All right, oil prices could be heading higher. What we are seeing may be a technical pullback, but Brent crude is currently at around $87.5 a barrel. But we'll move on, and just wanted to pick your brains on the earnings season. We are in the middle of the earnings season. What are your expectations? A better quarter this time around, considering that inflation has, at least for us, come off nicely.
So there's a steady slowness in growth rate, but growth continues. I mean, we were at over 30% growth for Nifty in the September quarter, then it slowed down to maybe 24%, and then this quarter will be further slowed down to maybe 18% maybe. But you continue to see positive growth. The problem in our market is not growth. We've seen consistent growth at an aggregate level. The problem really is whether valuations are right or not. Have we priced in all the growth for the time being, for the next year or year and a half? I think that is the issue with many sectors, and specifically that becomes more highlighted when bond yields go up, right? Because interest rates are a very important factor when you do valuation metrics. That if you have interest rates very low, your discounting factor becomes aggressive, and therefore you pay a higher premium for stocks. Whereas if interest rates are high, your discounting factor is more, much lower, and you pay a lower premium for, value. So that I think is something that we have not really fully adjusted to, because valuations around the world are still based on the previous regime of near zero interest rates. There was some correction to that front in 2022, but since we've gone past the highs of 2022 now, that's sort of gone, so that process that had sort of started is again on the back burner. And I think that is the risk when you're seeing rising bond yields. The risk is that you get a valuation correction, not a growth correction yet at this point.
And I mean, just one last question from me. IMD and SkyMed, they are projecting a better monsoon for calendar 2024. I mean, that has been a problem considering that, rural demand and rural consumption has been a big pain point for Indian markets. With this, do you expect a turnaround over there, rural consumption and demand, sir, if the monsoon is indeed better?
Uh, Yeah, it's a tough one because you can increase income, but have you also increased the cost of living, which then eventually results in, whether you spend more or not. So it's a very thin line when it comes to rural income. But you do get, out of 9 out of 10 monsoons actually end up being good in India. We do look every time in that direction just in case there is any risk to markets from the agri side. But in general, I think we've seen so many years where it's generally positive. So yeah, I don't know beyond that what more to say. So it's at least not a sentiment spoiler as of this moment.